better. So
Yeah,
I wanted to just hear your viewpoint as somebody that did this in more depth,
yeah,
obviously.
absolutely.
And obviously, because I think you transitioned, if I'm not mistaken, into more of like a risk-based role after doing a lot of like financial work, correct? So you have a very thorough understanding of the investment process and how to assess risk.
Yeah, the fact was, just to give you a little bit of context, because this may not be very clear, is that even though my career was always based on risk management, all right, my
Okay.
formal career on the side, because I had time and it for me it was something that I was really interested at the time. I began doing some presentations showing my value proposition, my investment strategies, how can I help specific individual investors to build their portfolios and all that. So in that case, I have this sort of double-edged career in which on the side, on my formal side, I would be working, of course, in risk with a formal employer in companies, central banks, fintech startups, and all that. And then
Okay.
on the side, I work with individual investors in which I would, first and foremost, anyone who wants me to help them, we would have an in-person meeting, and then I would have to know everything about the person in terms of its like risk tolerance, their career, their number of dependents, their career aspirations, their retirement plans, their retirement age as well. What is his current state? All right, and also the finances, how much money they have for specific expenses that they need to cover in terms of their day-to-day basis. And so once I have this profile of the person, then I would of course, upon request, if a person tells me, "Oh, I'm interested in investing in this particular stock or bond, would you make me a research and would give me a recommendation?" I would be paid in that case a flat fee in order to avoid any conflict of interest. And then I would, after some research, I would present my case and I would tell them, listen, I would recommend this to you, yes, because it's in a fair price. It's appropriate for you given your investment objectives and your current situation. Or I would say, no, this is not good for you. I would much rather you take another investment if you prefer, because it's much more suitable for you. And just to give you some context, when I was working at the Portuguese Central Bank, I had a lot of offers, for example, for research commercial banks back in Portugal, and they were willing to pay me like double or triple the price, and I would have to always refuse that because I had access to inside information from those commercial banks, and so I would be not be ethical for me to provide research on that kind of entities. And so I always try to do things the right way, even though I was not a formal advisor, you see. But this is something that I wanted to get into, of course, at that point in my career. And then I said, all right, this is way too informal. I'm going to try to do the CFA, do the CIA, the Chartered Alternative Investment
Yeah.
Program as well.
And that one's interesting because I don't
Yeah.
know too many people that do that one, and I wanted to understand, after having done those programs, what do you see, like how do you position yourself, and how much of that learning do you apply? And so these are obviously follow-up questions and not what I want to discuss right now, but this is, yeah, what I was,
No, it's okay. I'm perfectly able to give you the rundown of all this. Basically, for me, the CFA and later on the ESG investing certificate and the CIA, for me was seen as a little bit of a gateway in order for me to get into this career. But as it turned out later, I noticed that it was very difficult for me to get into such roles, and for good reason, because if you are a recruiter, you open a vacancy for a research analyst, a portfolio manager, or something in M&A, for example, and you receive a number of applications and you see a number of candidates which have formal experience in these fields. And then you see someone who has the CFA charter, the CIA, but has no formal experience. So you have no way to prove that that person has actually experience in this field. Of course, that application will fall by the wayside, and it will not make even the shortlist for the first interview. That is why I was never able to get into these sort of fields. But in any case, I get the knowledge. I still advise, of course, clients every now and then very far in between because now I'm no longer in Portugal, so I don't have the time to do that. But if they ask me something like some short-term advice, a quick one, of course I will help the people, and I also do some training on my own. I also manage my own portfolio. Besides doing equities, I also trade options as well. I have my own investment strategies when it comes to options, and so the knowledge that I got was not wasted because it's something that I enjoyed for me knowing and also applying as well. So for me, it was a big investment in terms of my time, in terms of my career, my personal life as well. But yeah, I can live with it for sure.
Sure. So what I'm hearing is that you don't have formal experience as a portfolio manager, but you still do advisory. Is that what you're saying?
Yes, I did several years from 2014 up to 2021. Then as I moved abroad, it was almost impossible for me to keep up because I had to move abroad. I had to move abroad. I have a full-time job in very demanding schedules. I was also doing the CFA and later on the CIA and the ESG, and having to spare time to attend to the needs of people who were not within my vicinity, were thousands of kilometers away from me. It was very complicated. And so for me, I was not willing to devote as much time to that because I did not have the control to do a good job as I would have if I was back in Portugal. But in that case, yeah, I'm comfortable with that decision.
Okay, cool. Thank you for kind of sharing all of that. Yeah. Yeah, so I was actually mainly on like open to hearing your viewpoint about like the way ESG is implemented correctly. And I think my view was
Yeah.
that there's a lot of indirect risks in the value chains of investee companies, especially when they're smaller. They're not so prevalent because they're still pre-growth stage. If you're thinking about like prior to scaling, it's just that when you scale them up, the value chain becomes more complex, the supply chain becomes more complex.
Yeah.
And I feel like when you're doing the initial investment appraisal, no one really wants to kind of go into those nitty gritties.
Yes.
And whereas I'm like, from an ESG point of view, this is super risky. And
It
if we
is.
want to kind of move away from this risk profile of like certain industries that are heavy on risk, like mining, for example, how do, and it was funny because I was trying to kind of support some of these arguments in the work that I was doing, and it was just really not top of mind for a lot of people. So I wanted your viewpoint in terms of, are there any sectors or asset classes where you actually see positive correlations between ESG risk mitigation plans and profitability, of course? And generally, after having done your ESG certificates and the education that you've had, how do you see kind of bringing that into your profession or the stakeholders that you're liaising with in terms of like active stewardship? And,
Yeah.
you know, and I think what I read in directives, that's like actually engaging people in discussions and spreading awareness and not just like checkbox exercises, right? So I was very interested in the governance of all of that, actually, much more than the financials. I mean, that's not even really my strength, to be honest. But yeah, I think having like worked in alternative investments like yourself, central banks, as you mentioned, and like you've just got the whole spectrum of financial stakeholders, and like who's actually on board the ESG train, and how did you bring them on board? I think that was
All right. A lot of unpacked in this question, but I think I picked up everything that you need to know. The thing is, first and foremost, in terms of who has to benefit in terms of asset classes, well, potentially the asset classes in which you can make the most research and the most due diligence are potentially the ones who has the most benefit because you can, by having your proper due diligence process in place, and you have, and this is very important, the availability of the information. And for example, if you are researching publicly traded companies who have very strict reporting requirements, it's much easier for you to assess whether they are fulfilling their ESG objectives and all that. And so because of that, you are able to make most of the more difference than, for example, investments in the private sector in which the information is much sparser. And you cannot have you don't have the instruments to make that degree of due diligence, you see. And so it's much more difficult to ascertain the difference. And many times you have to go between interviews with the people who are running the business, and also other factors that bits of information that you can get from that, and then you have to use your gut feeling to see if there is actually something material in terms of ESG, or you are being greenwashed, as they say in the term, in
Yeah.
the jargon.
And I think the term greenwashing has also really come up with, because a lot of the quantifiable metrics, as I'm sure you
Yeah,
understand better than I do, are very
yeah,
much in the realm of carbon emissions, and like
yeah,
everywhere you go, it's just like decarbonize everything, which is super important. It's just that some sectors have a very social, like a huge social risk to it if it comes to
yeah,
labor rights violations, for example, but it just doesn't seem top of mind. Um, and I think greenwashing, again, I personally don't have enough experience with like when something is greenwashing and when it's not. um,
yeah.
so I guess you
But
have to be careful about it and you can
you
flag it
have,
as a risk.
yeah,
But I don't know to what extent, like, because there's also scope 3 emissions, and those are indirect, those are like supplier emissions, and those
yeah,
typically are not even within scope, right?
yeah,
Of when you're assessing. Yeah. So, and I think it's also not in the mandate of a company. If you're looking at like a company like Shell, they don't actually measure, and they're not reporting on scope 3. I think it was like a board decision not to do that. It was one of their strategies.
yeah.
So, yeah, it's now I'm kind of rambling, but it's just seems far too complex to kind of consolidate into like one risk mitigation strategy. So
Yeah,
yeah.
there is no one size fits all, absolutely. And in that sense, I think it's a mistake that you consider, for example, specific ESG scores and specific metrics in absolute terms. You can't do that because you cannot compare the ESG performance of, for example, Shell company or British Petroleum company, for example, with a company who is, for example, a technology company, a Google or an Alphabet or a Tesla, for example. You cannot, because you are not comparing apples to apples. You must make always a comparison in relative terms, in which the companies that you are evaluating are compared relative to their peers, you see, in the industry. And then you can make an assessment whether the company can make progress in terms of ESG. But then again, we are talking about companies which, of course, due to their own intrinsic activities, they have a large environmental footprint, and
Yeah.
because of that, I think it's an illusion. It's an illusion to believe that these companies will be completely clean from an environmental perspective.
No, it's
I,
not
it's a
possible, of course
misnomer.
not.
It's impossible. But
Yeah.
one thing that we need to keep in mind is that as they can make some progress. They can make some progress, especially when it comes to disclosures. For example, you were mentioning about scope 3 emissions. Of course, scope 3 emissions are extremely difficult to assess
Yeah.
because you need basically, it always depends on how far you want to go with this. You can go as far as, for example, because you don't want to have too much work and you can't afford to have that much work. You basically can understand from their annual report and their sustainability report what companies are at the top and at the bottom of their supply chains, and then see their own sustainability reports and annual reports and see how they stack up in terms of ESG performance. But if you want to go deeper, and you can, if you have the resources to do that, one thing that you can do is basically try to engage really the higher ups of those organizations in terms of their C-level, their C-suite, for example, and
Mhm.
then try to bring more information about their ESG performance. And sometimes they may give it, sometimes they may not give you, but the important thing is that how far you want to go. This is the level of engagement and stewardship that you are willing to take. This is very
Mhm.
important. You need to establish your boundaries, and then based on those boundaries, you will be able to have you'll never have the complete picture, but as long as you can get enough information for you to make a conscious decision to the best extent possible, whether this company is completely not fulfilling his own proposition in terms of ESG, or on the other hand, all the signs, even though they are not 100% conclusive, all the signs point that the company is doing some progress. All right, that is good enough, because at the end of the day, we need to understand that there is no business today. There is no business today that it is completely devoid of carbon emissions. even if you are talking about electric vehicles, for example. Today I was talking with a colleague of mine at work. Electric vehicles, for instance, most of their emissions in building that car relative to a car with a combustion engine, most of those emissions in building the car are upfront. So you can only offset and more than offset the emissions if you keep the vehicle for 8, 9 years down the road. If you are switching vehicles every 2, 3 years, forget it. You are making more, causing more emissions to the environment than with a combustion engine car. And not only that, if you go to a charging station, if that charging station gives you electricity to your car, which is powered by coal, you produce electricity out of coal, where is the sustainability aspect in here? You're making even more damage to the environment by using electricity produced by coal. So it doesn't make any sense. And you have no way, it's very difficult for you to know where that energy was produced from. It's very difficult. You have to go really, really deep in order for you to get this kind of information. And so whether the company is really making progress or not, it depends how much can you ascertain for a specific investment or a specific company that you are considering getting exposure to, basically.
Yeah. Okay. So just to make sure I get it right, it's just very tricky to assess the full scope of emissions, like you're saying. There's not a particular business that's devoid of carbon emissions like you're measuring.
Yeah.
So you have to look at the scope initially of your investment, the intended application, the industry that the company is going into, and then the growth trajectory. If you can extrapolate, for example, if the footprint you estimate at current at like I don't know 5, and then you might say, okay, given this level of growth and this jurisdiction and this level of activity might be within this threshold, of course. And then kind of reflecting back on that, you kind of make that point of time assessment, and then you maybe like put in footnotes or whatever that there will be potential risk moving forward, right? That would be
I can tell the methodology that I usually used when I assessed, when I incorporated ESG in equity research, for example, is when I do this, I cannot only focus on the company I'm considering getting exposure, or some
the industry,
or some client of mine is considering getting exposure to. I would have to consider the peers in the industry, as you said, and very well. And I would have to see, based on the information that is close, which of course is as accurate as they can get. You can never have foolproof information, but you establish two boundaries, which is the best performer and the worst performer. And you establish a range which is bounded by these two values, and then you'll see where your company stacks up, how far it is from one edge to the other, you see? But for me, and I think this is a very important point, is that this range is not linear. You don't do a simple linear interpolation. And why is that? Because, for example, let's just say a business that produces 500 tons of CO2 per year, for example. And it doesn't matter where it is at the range. But let's just say it's a little bit closer to the bottom of the range. It's much easier for this company to make some progress in terms of ESG and go from 500 tons of CO2 to 400. All right, it's easier for them to do this progress than if it is, for example, at 200 tons and try to go to 100. All right, it's much more difficult to go from 200 to 100, right? Because the marginal progress that you have to do is much more, because you are already much more sustainable. Your practices are already improved it to some degree. And so in this range, what I would do is that any transition from 500 to 400, I would value on a much larger progression up the scale, and a progression from 200 to 100 would be much larger because it's more significant. It requires more effort, you see? Do you get my point?
I'm trying to understand, but you mean at an organizational level, correct? Like you're
Yeah.
So and the numbers you're saying are basically the thresholds of carbon emissions, for example.
Yes, this is just an example. How can you incorporate ESG in terms of one specific metric whether the company has a good score or a bad score. This is something that you can use. It's a very archaic, very basic metric, but it's something that based on information that you can get, it works.
Okay, super interesting. And so you're talking about in the context of equity research and how do you incorporate ESG metrics? Okay. As far as my understanding goes, these are directives in Europe. So there's obviously the stewardship component, but also just like the reporting requirements under SFDR. I don't know that it depends on the size of the business. I think the number of employees and the annual turnover. So
Yeah.
you're looking at like, I think the upper end of SMEs that really need to report more stringently, and they have to be public, right?
Yeah.
And I guess if you're managed, if you're a
I
smaller
get, sorry to
client,
interrupt. You are talking about the CSRD, correct?
in
The
terms of the
upcoming,
sustainable
the
finance,
upcoming.
yeah, CS, but also the sustainable finance regulations, so SFDR disclosure, yeah, that one, because I think there's an element in there as well.
All right.
But just for me to understand then, so what I'm hearing is that there is a prominent role. It's very much the avoidance also of greenwashing, because that's a trend that everyone wants to avoid. So it's important to have a methodology that's robust, meticulous,
Yeah.
and to kind of create a range between the best performing companies and not so good performing companies, and then position your target or whatever you're researching and try to place them there, and then evaluate what the gaps are towards moving towards the upper end, or how far are they away from the lower end. But maybe
Yes.
my answer is, when you have that range for yourself, you're setting that range above the minimum threshold, right? So
Yeah.
essentially, all of those companies are somewhat sustainable. It's just that some are more sustainable than the rest, and they can play catch up. Does that make
Yeah.
sense?
Yeah.
Okay.
This is something that I create on my own. You see, this is the way I can incorporate a specific metric, all right,
Okay.
into by considering relative to its peers in order to get a ESG score, you see. And by doing this for several companies in the same
Okay.
industry, you then have a rank of the companies in terms of their ESG performance, you see, basically. But
Okay. Great. Thank you.
one aspect that for me is very, very important, and I think is highly disregarded, is that for many people ESG is all about the environmental component, and I think it's a very, very big mistake, because for me, if you ask me what is the most important component of ESG, I would say always it's governance. It's governance, because if you don't have a proper governance structure in the company, you can potentially be investing in a company that will not be there for the time for any future significant time horizon, because with a faulty governance level, you will have potential conflicts of interest among the members of the board with their with other third-party entities. You will have all sorts of conflicts of interest, potential fraud involved, and so these things at some point catch up with the company and with the regulators. And if the company gets its reputation tarnished up to a point in which it really jeopardizes the business, your investment goes all the way down to be completely worthless. And so for me, because the company can be really in danger of its existence because of the governance component, not from the other ones.
Yeah.
This is something that for me,
Yeah.
it really tips the scales towards the governance
Well,
aspect.
thank you so much, because I feel like governance, but I'm so new in the industry. It's spoken about, it's written about, but it's just not top of mind, because at the initial stages, you want to make sure that this is robust enough that there's a return for your LPs or your investors,
Yeah.
depending on who's actually investing, of course. But also, I mean, I've not engaged with the board or the C level to understand how governance issues are impacting. I mean, to what extent these risks are actually impacting the reputation of the company. I mean, obviously, you see sometimes stock prices drop in case there's like scandals or whatever, and I think those are like those are for public companies, of course, and you see like investors losing their money. But I'm not maybe aware to what extent then the repair mechanism comes in that sort of situation. The damage control, I guess, is obviously public relations and the media to like
Yeah.
kind of quieten people down so the market recalibrates, of course.
Yeah.
But I think I guess you would reevaluate processes. You might cleanse out a few people, and you might remediate that type of thing until your stock sort of bounces back. But yeah, sorry, maybe I just don't have that oversight into what type of mechanisms are put into place, right? Yeah.
There are very, very easy signs that you can spot just by knowing the company, just with an overview of the annual reports. For example, as you probably know, there are several governance structures of the board, which are traditional from one country to another, in
Yeah.
which you can tell that, all right, the way the board is structured, this is something may go, the possibility that something would go wrong is higher or lower. For example, just a brief example, here in the Netherlands, usually you have, for most publicly traded companies, the board is double. You have a supervisory board, which is
Yeah,
mostly
it's
composed
both
of
IL structure, right? The
independent
executive and
members,
the yeah,
and then you have the executive board, which is composed of other people.
correct.
This is, in my view, the best. Of course, it's expensive because you have a double board, but this is the board that protects most the investors because it gives more independence between the ones who are executing from the ones who are monitoring the performance of the ones who are executing the daily action in the company. But for example, if you go to France, for example, which is quite traditional for having a board in which the CEO is also the chairman. So this is something that, all right, basically what you're saying is that the one who is executing, which is the CEO,
Is also deciding on governance matters,
also
right?
has
Yeah.
the power to supervise the action of the executive board. For me, I'm not going to say that this will lead to a scandal every single time, but is more prone to have conflicts of interest. And then
Yeah.
you see what I'm getting at? And not only that, for example, another huge red flag, and this is something that must be disclosed to the supervisory authorities, which is having dealings and transactions with third-party entities. A board member and any senior management member should not, in any capacity, have third-party dealings with other entities because conflicts of interest creep in. You should not be able to be on a board of a company in which you have access to all sorts of confidential information, and then making dealings like you're selling goods and services to other companies, and basically you are at risk of trading away confidential information from the company that you are a member of the board. This should not happen. This must be disclosed, and
Okay.
sometimes, of course, supervisory authorities may request additional information, as they should. But even so, the mere fact that this can happen and slip through the cracks because it has all the appearance of being, oh, this is not illegal, nothing wrong is going on, but the fact that there is the possibility of something later down the road being happening that would jeopardize the integrity of the company and the C-suite. This is something that is serious. And in my view, it's a huge red flag. And if I see one of those investments that I have, or I used to advise my investors to do it, to basically invest in it, I would say no, because this situation in terms of governance, there is no independence that would ensure that this company would be able to stay abreast, completely, not abreast, but completely isolated from the possibility of any regulatory penalties, possibility loss of license if they need a license to operate. No, you should not put yourself at risk because of that. But as I said, you always have to keep in mind what is also the tradition of the country you are looking at. For example, I know that the Netherlands are very good in that process. They also have very good regulatory authorities. I think the AFM and the DNB do an awesome job in that respect. But as I said, you have to also to keep in mind that. And also, for example, some other things which also are less obvious. If you have, for example, an internal auditor, which, for example, is not completely independent from the rest of the company, which has to have which has other reporting lines, not only to the audit committee or to the board, but to other members of the C-suite, or for example to the risk. Doesn't make any sense. Or you have, for example, an external auditor would provide you with auditing services and at the same time provides consulting services. This is a huge red flag. This should never happen, because if they are on the auditing side, they are basically making sure that you are completely isolated from any potential fails of internal controls, and they are making sure that your business is running properly. They are not there to collect the fees from their own business. And so by having a consulting business going on in the same company, they are doing an audit. This is something that is absolute no.
Yeah, but I think you see that in larger management consultancies, of course. But I haven't come across that at a smaller company level, so I wouldn't know. But I understand that there is a Chinese wall there, and that I think there's a cap on the value of the assignment that you can do, right? Like as an auditor
Yeah.
versus an advisor. Yeah, that's fair. Okay, super
This
interesting.
this is more. I must say, this sort of situation is more likely to happen with smaller companies, because of course in publicly traded companies this is a huge red flag. And not only that, they get better prices because they get a bundle of services. We audit you, and in the same time we provide you consulting services. And because of this, they may get a discounted price, and so they will be able, of course, to get a better value for their money. But this is not good in terms of conflict of interest.
Fair enough. Um, okay. So I mean, I'm learning a lot from this conversation. I really appreciate your taking just like a lot of time to explain a lot of these things and why certain things are beneficial or not. I think I was missing that very much as a kind of a mentorship
Yeah.
opportunity actually in the investment space. So thank you very much.
No, it's okay.
I'm actually kind of just looking for like more exposure to the ESG space. So if you know anyone that I could speak to, I would be really happy to kind of explore further actually, because I think that's kind of where my interest is also. And more kind of learning about investment appraisals, not the core financials. Like I don't think that's my strength, like numerically. I'm much more on the conceptual kind of level. Like investor stewardship, responsible investing, impact investing, all of those things is kind of really, what I'm kind of looking around for.
These are things that you must keep in mind. That's why many asset managers and even small investment boutiques, for example, are somewhat limited in terms of the degree of stewardship that they can perform, because it is costly. It requires a lot of time, a lot of resources, and many times, even if they put in the effort and the resources in and commit themselves to try to do a proper stewardship of the assets they are managing, sometimes, even if they do so, because they may lack the connections with the companies and with the higher ups of the company, they may not get access to that information. And so this is an investment that they are doing on their own behalf, in which they may not get the proper return. And so there are, for the smallest asset managers, which don't have too much leverage, they don't have sometimes a proper context, the contacts, it's difficult for them to do proper stewardship of the assets. And so it's important to understand that, all right, they may not be able to do it, but at least they must do some due diligence on the side of the companies in terms of their governance. And for me, as I said, the governance aspect is extremely important.
Yeah,
It's
for sure.
it's beyond going simply to the annual and to the general meetings of the companies. Is more than that. Is going to the meetings and having the opportunity to do some proper questions in terms of the performance, the details, how they are progressing in terms of ESG, what they are doing in order to be able to perform to the level in which they promised the investors they would be able to do that. This is something that they must be able to do without that much investment. This sort of standard minimum level, they should be able to do it. Now, in terms of context and having specific and personal meetings with the higher ups at the company, this is something that, of course, is more expensive because it requires more context, more time, and all that. One thing that I think we haven't touched on is, for example, it's not too regarded, it's a bit overlooked, is a social component. Because a social component of ESG, sometimes even it tends to get too far in terms of the diversity and inclusion and all that, because sometimes companies want to portray themselves in a way they are fully open. They try to do all the parity in terms of males and females and all that, in terms of backgrounds, from in terms of countries, backgrounds and all that. But you have to keep in mind that this can become costly to the company, because first and foremost, the job market at this moment and in the past few years has been tight, so the talent is scarcer, it is becoming more expensive, and so if you put in additional criteria, you may be able to get your DEY correct in terms of the diversity of the team, but you may not get the skill sets that you need to pursue your business properly. This is extremely important. And that is why today, if you talk with the CEOs of some companies, you will start to get some pushback on this, and they will start to say, I don't care about DEI. I care about performance. I don't care where that person came from. It doesn't matter. For me, all I care about is performance. If you see.
And I
Yeah.
completely understand that. And I think as you start expanding your net for a wider range of talent and you're actually
Yeah.
improving accessibility to those roles, but getting those people onboarded to the level that you want. And I think I myself am an example of someone with a non-traditional background that was trying to work in PE, and there's a certain level of performance that is expected. And it's hard. Like I don't have the caliber of like the financial skills that is required. And it is an investment, but that investment could go into like actually raising funds and then growing the business, and it's
Yeah.
always that trade-off, and that's why it's super important to, I think, be self-learning, but it's just, if you think about it purely from like performance point of view, it's in the interest of the firm to hire people that just have the relevant skill set, and whether that means that it's not diverse, it's not diverse. But then I think,
Yeah.
I think that's a whole other I mean, yeah, it's just like a whole other
I
ball
know.
game
I
altogether.
understand. Yeah.
Yeah, so it's interesting. So how do you, I mean, do you see like when you have more ESG frameworks in place that there is a push, or that's easier to secure investment for that type of thing, so like talent
Can
development?
you repeat, please?
So
There
when
was some
you,
trouble in the connection.
so when there is like official ESG frameworks in place in the company, within the company, is it relatively easier to argue in favor of investment for talent development and capable? Because if you're looking at funds, right, like a lot of the money is invested, so you have very limited kind of the what is the operational fee for the managers, and
Yeah.
I think that piece of the pie they want to keep as expansive as possible. So I don't think there's a lot of heavy investment in like talent development and socials and like team building. And I think
Yeah.
because that's just traditionally how the model works, right? So do you see that kind of changing with the implementation of all of these directives, that there will be more of an emphasis on
Sure.
inclusion? I don't know. Yeah. And what do you like? What are the methodologies for that, really? Like you might have
Your
diverse voices and that type of thing. But
your
yeah.
your question comes right on point, because I think about 2 months ago I did a video I posted on my YouTube channel, because I saw the news on the Financial Times in which there has been a stagnation in terms of the number of funds, investment funds based on ESG, which have been created. Before that, they were popping up like there was no tomorrow. A lot of funds based with ESG incorporation into their investments, they were popping up everywhere. But over the last year, as regulatory requirements became stricter, the growth of the number of ESG funds has basically stagnated. And I can imagine why, because most of them were pursuing an investment strategy based on ESG, in which, even if they were willing to do the right thing and doing everything transparently and in the right way, at this point in time, there is not nearly enough assets available for the amount of capital that is seeking those kind of investments. And so because of that, many asset managers were forced to, of course, they would invest in these assets, but sometimes at not very good price entry points, And then they would have to diversify their investments in non-ESG assets. And so when the new regulatory requirement came, in which I think you have to, for ESG funds to be labeled as ESG, I think they must have like at least 80% of the assets under management invested in ESG assets. Once this requirement came into play, the number of funds basically started to stagnate. And for good reason, because they were not, even if they wanted to invest only in ESG assets, which at this point in time, we have to be honest, you don't get the same risk return relationship that you get in traditional assets. You don't get it, you get it lower. But then you will see that even if they want to invest only in those assets, there are not enough assets available, because it's still something that needs to be developed more. You need more investment in infrastructure. You need more research and development in order to have those assets in place. You see, when you have an absurd amount of capital seeking those particular investments, you won't get enough assets to invest. And so I can understand why this is happening. And so coming back to your question, in terms of the ESG framework, the ESG framework at this point, in my view, is something that must be kept really, really dynamic, because today the ESG regulation for investment, not only from the perspective of investment funds, but even asset managers and all that, are on a very rapid change of pace, because we are constantly discovering new assets. All right, it's no longer just the wind farms and solar farms that we used to do in the beginning. Now we have also the context, as you mentioned, impact investing, that it's very important for very specific communities across the globe. Also, you have to keep in mind, of course, the improvements in terms of governance that come into play for specific companies, which are, for example, in private equity, also in the funds themselves. When you have, for example, a private equity fund, you have a general partner that makes co-investments with along with the limited partners. The limited partners must be in some way secured that their money is being invested in the same way as it would be if the general partner would not make a co-investment along with them. Because it may happen that, all right, the general partner uses the cash from the limited partners to leverage its own investments, and when it comes to separate the investments among each of the limited partners, he would get an allocation at a better price than the limited partners would. And so you would get better returns at the expense of the limited partners. It doesn't make any sense. And so there is also some margin of improvement in there. And because of that, we need to keep in mind that this is constantly changing. It's constantly improving, as you can see also with the CSRD regulation that will come, that is already ongoing and will continue to go until it's fully implemented up until 2028. And you will see that along the way, the regulation will change, because this is constantly improving and in a very dynamic segment of the asset management industry. And so these frameworks, for me, are unstable, and you don't take it as something which is completely set in stone. You must take it at face value in some way, and they are only relevant to the time today. In 1 year time, 2 years time, 3 years time, it may be completely different. All right, because things change, and in a very rapidly developing industry and segment of the industry, which is the ESG segment, yeah, a lot of things are changing. Yeah, one example that I can give you: the airline industry. At this moment, the way ticket prices are being charged to the customers, to the people who want to fly,
It's all
they are
offset to the customer, right? Like the carbon offsetting is very much the cost that the end customer absorbs
yes, yes,
for flying, right? And
yeah.
I mean, it's one way. It's a very transparent way of distinguishing the cost. It's obviously like there's one specific amount you pay on the flight ticket, and then you have ranges of flight tickets that you can kind of, I think, work with to make sure that at an aggregate level you offset those emissions between your customers. And then the idea is that those who can pay for the ones who can't pay, right? And that's kind of the idea. Like medical services has the same structure. If you're looking at like really ultra high like high cost surgeries, you typically, like, doctors will discount the rates for lower income patients and then charge a premium for the ones that can, differential. I had a debate on this, and apparently it was not considered ethical because it's like giving everything to the end customer, but I'm not sure if there's an alternative model. Unless you change the fuel structure already, which is what like the Boeings are trying to do. And the Shells are trying to develop on, and that's going to take some time, of course. And you might try to maybe, I think you can do something with the emissions if you can do direct carbon capture and then like circulate those emissions. I don't know.
You can.
That could be something.
But not today. But probably not today. With the technology that we have in place,
exactly.
not today.
Yeah.
And you have to keep in mind, for example, as an investor, you see that your company, your airline that you are investing, I'm not going to name any names, but we all know the low cost companies that are operating in Europe. You can imagine, for example, all right, if you pay an extra on top of your ticket, they will offset the carbon. Some of those companies out there, they do that. But now you have to wonder, how can an airline offset the emissions of an airplane? You need to dig deeper, because at first glance, you don't see how this can happen, because it makes a huge impact on the environment. There is a lot of carbon to offset, and it's not because you're paying 10 euros more on your ticket, assuming, for example, that all 120 people or 150 people that fills up an airplane will pay that extra. You will get what, 10,000 euros at most. I'm talking very, very round numbers, but what you're going to do with your 10,000 euros per flight in which you are going to offset such a large amount of emissions on the flight. It's difficult to know. And if you go to the C-level of these companies, most likely they will not be able to give you a definite response, because it's difficult. I'm not going to say this is a straight up greenwashing, but it is something that makes you wonder, is this really like that? And I'm not really sure. I'm not convinced at all, because how can it's not a car, it's an airplane. It consumes a lot of fuel. And one thing that you need to keep in mind, and this point is extremely important, which is, as long as companies as long as companies no as long as companies are making money, and for example, the low cost airlines in Europe are among the most profitable airlines in the world. As long as they are doing this kind of money with this kind of margins, I will be tempted to ask how much of an incentive they have to transition from the fuels they are using now to sustainable fuels, which in the beginning will be much more expensive. So the margins will go down, and they will have then to explain to their shareholders and their investors, you're going to have lower profits for a couple of years until the technology of creating and producing sustainable fuels matures enough so that you can get your margins that you had before later down the road in a few years' time. Investors are not going to wait. They don't want to wait, you see?
No, I think unless there's a very stringent regulatory mandate to do so, and I think that will happen with all of this decarbonization, potentially EU Green Deal. I think there's a green chemicals strategy that it's a strategy, it's not binding yet, but if, for example, the EU decides to ban certain petrochemical uses in the airline industry, or they curb the amount that you can use for short haul flights, for example, and that's likely because I think takeoff and landing emissions are higher than being on cruise control. So the more you do that, and that's what low cost drivers apparently do, that could be something. But that just means that there might be subsidies to do it if there's a strong pushback from the airline industry saying we're not going to do that, and that's the
Of course.
mechanism you get into, potentially.
Yeah.
And this is just hypothesizing one of it. So that's the financial mechanism to get those companies to transition, and then that's kind of also where the investors might, I think, hold for a while.
Yeah.
And then they might start reinvesting once that industry kind of bounces back. And right now it's not, because I think following COVID, there's been a huge kind of restructuring there as well.
Of
And
course.
now, because of all of this greenwashing and like Gen Z millennials don't like flying long haul flights because it's not ethical, and so I don't know. These will be like the mechanisms influencing the market. Obviously, I cannot say what will happen in the market that way, but it would have to be a strong regulatory driver, and potentially that's
And not only
possible.
that, apart
Yeah.
from the regulation, one thing that would be a good solution, if it's properly implemented, which at the moment it is not, is the carbon market. Because a well-functioning carbon market, has the advantage of, since you have a given number of emissions to buy and sell in the market, the highest bidder will have to buy those emissions, will be able to buy those emissions, but and so it could pollute more. But by buying those, the cost that he will have will necessarily push down the incentive for him to continue polluting, and then generating all the negative externalities, which would be falling upon everyone else. You see, and so by having a proper functioning carbon market in which you have those credits in terms of carbon emissions being traded among companies in a specific market, all right, this is something that would work really well, but there would need to be the regulation in place to oblige companies to really operate only under the auspices of this carbon market, because otherwise, if they are not obligated, there is no incentive from the airlines to operate in this fashion. It's impossible, and so you need to have a really strong regulation to foster and to make an obligation the use of a carbon market, well functioning one, and adequately regulated, to make sure that the companies will have to buy carbon credits in order to operate as they want. But of course, the more they buy, the more they can pollute, but that comes at an expense.
Sure. Sorry, I'm really mindful of the time. I think we've been speaking for about an hour, and I don't know, because you're still working. I really appreciate you kind of like explaining all of this to me, because I really needed an insight like that. I'm happy to schedule a follow-up call if that's okay with you and if you have time. Alternatively, like I said, I'm very kind of interested in this industry, especially from the ESG point of view. So if there's maybe anyone else I could actually reach out to or speak to, kind of appreciate that as well. Sorry, I just don't want to take up more of your time tonight because it's quite late.
Got it.
Yeah.
For me, you are completely at ease with me in that respect.
Thank you.
Just reach out to me on LinkedIn. We'll schedule another call. For me, it's a pleasure, because at the end of the day, it's also a way for me to keep myself updated and be able to pass on the knowledge that I have over the course of these years. Because as you can see, I was not able to use the knowledge that I accrued for so many years. And now for me, this is an absolute pleasure. And feel free to reach out whenever you need. We'll jump into another call.
Super appreciate that. I think just to reflect on that, I'm happy to maybe put you in touch where you might be able to actually apply some of this expertise, given that you are qualified. And number two, you share your knowledge with so much ease, and I haven't actually seen that a lot in this sector. I think it's been like very much I think people are just really busy, but it's very much like kind of protecting their knowledge and their experience. So this was very refreshing for me. Thank you.
It's my pleasure, Gauri. My
Thank you.
pleasure.
Have a good night. Bye bye.
You too. Bye bye. Thank you.